TV with me, Asma. In a recent address at the IIMK NSE annual conference on macroeconomics, banking and finance, Rajneesh Karnatak, Managing Director and CEO of Bank of India, shared insights into the future trajectory of government ownership in state-owned banks and discussed the potential implication for the banking sector. The conversation primarily revolved around the prospect of the Indian government reducing its stake at these banks, especially as the country's economy continues its growth trajectory. Karnataka also touched on topics such as deposit rates, interest margin, and the likely impact of the Reserve Bank of India's monetary policy on the bank's finance. Here's a special report from Foresights TV. Karnataka raised the possibility of the government reducing its ownership in state-owned banks, particularly given that India's economy is on an upward growth path. He emphasized the importance of capital for sustaining and funding economic growth, and reducing government stakes would be one way to provide these capital requirements. As of now, the Indian government holds significant stakes in major state-owned banks: 73.38% in Bank of India, 57.43% in the State Bank of India, 70% in Punjab National Bank, 64% in Bank of Baroda, 63% in Canara Bank, and much higher in others like Central Bank of India 93% and Indian Overseas Bank 96%. Karnataka noted that while the government stake may be brought down, the final decision on consolidation or further dilution would ultimately rest with the government. He also mentioned that the government's potential action would likely aim to free up capital that can be used to fund growth within the banking sector, which in turn could support broader economic development. Karnataka also spoke about the Reserve Bank of India's recent rate cut and its implications for the Bank of India. The RBI reduced the policy repo rate by 25 basis points or BPS to 6.25% in February 2025. This was the first rate reduction by the central bank in nearly 5 years, prompted by easing inflation and slowing economic growth. According to Karnataka, Bank of India's external benchmark linked loans or EBLR have already reflected these cuts in rates. However, he indicated that a reduction in deposit rates was less likely in the immediate future. The bank's Asset Liability Committee or ALCO would meet later in the month to assess the situation regarding deposit rates and the marginal cost of funds-based lending rate or MCLR linked loans. This meeting would play a critical role in determining the bank's next step. Karnataka also acknowledged that the bank's margin would experience some short-term pressure due to the lag in adjusting deposit rates. The reduction in deposit rates would take time to materialize, which could impact the net interest margins (NIMs) of the bank. However, he stressed that the expected impact on margins would be relatively marginal in the short term. This is because while there is an immediate transmission of the rate cut to EBLR linked loans, the full transmission of the rate changes to deposit rates and MCLR linked loans would likely take about 2 quarters, as highlighted by RBI's Deputy Governor Swamithanan J. Rajneesh Karnatak's comments indicate that the government may consider reducing its stake in state-owned banks in the future, which could provide the banks with the necessary capital to support economic growth. Bank of India, despite potential margin pressure from the recent RBI rate cuts, appeared to be taking a cautious approach in adjusting deposit rates. With capital requirements growing and economic growth on the horizon, the banking sector is poised for transformation, and stakeholders will need to monitor these developments closely. That's all for today. Thanks for watching Foresights TV with me, Asma.